Chapter 4 deals with break-even and contribution margin analysis. This type of analysis is critical for any company. If you look at page 57 and 58 in your text, you'll see some questions that this type of analysis is designed to answer. And however you answer those questions are going to be very key signals for the state of your company and in what you need to do to move forward. Following are questions that the break-even analysis and contribution margin analysis is designed to answer. What sales volume is required to break even? What sales volume is necessary to earn a profit? What profit can be expected on a given sales volume? How it changes in price, cost, and output affect profits? And how would a change in the product mix affect potential profits? Those are just samples of some of the many questions that can be answered by this type of analysis. Now, the contribution margin is simply the amount that's left over to cover all fixed costs. I've put a video on Blackboard from YouTube. It's entitled I Ninja Notes, and that gives you some examples of what contribution margin is used to do and how it's calculated. And it makes it a very tangible way that you'll be able to see a contribution margin played out. Now, this can be expressed in a percentage or in units. So you'll see that contribution margin is your sales, the total amount of sales minus the total cost to accumulate those sales. Now, the amount that's left over is your contribution margin, and that's the amount that's available to cover all your fixed costs. Now, on this slide, you see contribution margin expressed as a percentage, and you see it expressed as units. Now, your little p in your contribution margin will be your price, and your little v will be your variable cost per unit. So that's per unit variable cost. Your contribution margin over your total number of sales will give you your contribution margin ratio, which is your percentage of sales in order to achieve the percentage of the amount that's left over to cover your fixed costs. Now look at your example on page 60 in your text. Now on page 60, you will see an example of unit contribution margin as well as your contribution margin ratio. So I want you to take some time to look at that to see if you understand it before you move forward. Now let's try an example together. Now, this is not in your text. And before you click over to the next slide to see the answers, see if you can figure this out on your own. Okay, is this what you got? Did you get contribution margin of 600,000, which would have been simply your sales, which is your 6,000 units, multiplied by your P, which is your price, less your variable costs. Should have got you this number. And then your unit contribution margin, which would have been your price, $150 per unit, minus your variable cost per unit, $50, would get you the unit contribution margin. And then your contribution margin ratio, which is what you would have received once you calculated your contribution margin, which is the 600,000 divided by your total number of sales in units, 6,000. Should have gotten you your contribution margin ratio. And then finally, your net income. Net income is the difference between your contribution margin and your fixed costs here. Now I want you to see an example of what the income statement will look like. Sales minus variable costs gives you your contribution margin, and your contribution margin, your fixed costs, gives you net profit. So you'll see on this slide, you'll see a traditional income statement format, and then you'll see your contribution margin statement format on the right. Now, there's no right or wrong answer on how do you present this information. It just depends on what you're trying to see. A contribution margin ratio gives you a more detailed breakdown of expenses and income, so you'll understand exactly what variables go into those numbers. Break-even analysis is where my expenses and my income meet. Where is that number that my expenses and my income both come to a sum total of 0? So I've also included a video in Blackboard from iNinja Notes as well that will give you a little more colorful example of how to calculate break-even analysis. But simply, it's the fixed cost over your contribution margin per unit, which will give you your break-even number in units. That's the number of units that I need in order to get to that place of 0. Break-even in sales in dollars is my total fixed cost over my contribution margin ratio. So what number do I need to achieve in dollars in order to break even? Now you'll see on this slide, these are the things that the break-even point is designed to tell you. And below here, there's simple steps that you need in order to calculate break-even. You need to know what the fixed costs are. You have to understand what the variable costs are, and you may have to calculate it if it's not given to you. You need to determine and understand what the profit and the revenue per unit of that service or product is, and then you can plug those variables in to get your break-even point. Now look at page 61, and just like you did earlier, see if you can figure out what the answer is on your own. Now let's look at this example. Remember these numbers from earlier? Now let's see if we can figure out what the break-even in units and dollars are based on this information. Now, did you get this answer? I hope so. So break-even in units is 4,500 units in order for this company to break even. And this was achieved by taking the fixed cost number here and dividing that by what? Absolutely. The contribution margin per unit, which is here. And that'll give you 4,500. Then, in order to get the break even in dollars, you take the same fixed cost number and divide it by the contribution margin ratio here. And it gives you this number. Total units and total dollars needed in order to break even. Now your target income volume. Every company is in business to make profit, which is a target income. And so there's a after tax and before taxes way to get to this number. Now fixed costs plus your target income over your unit contribution margin gives you your target income volume. How many units do I need to sell in order to make this target amount of income? And that target number is gonna, it's gonna be very relative to whatever number your company says that we want to make on this particular product or service. Now, when you're looking at your target income volume after taxes, it's slightly different. You still have your fixed costs, but then you have to get your after-tax profit number. So you take your target after-tax profit and you divide that over 1 minus your tax rate. And then that gives you the actual number that you want to make after taxes. And and you divide all of that over your contribution margin, and that will give you your target income volume after taxes. Now look on page 63 for an example on how to calculate this, how to solve this problem. Now let's look at this example. So your target income volume, and this is before taxes. So your fixed cost is $15,000. What you want to make is $15,000, and your contribution is $15. So your total is $30,000 divided by 15 gives you that your target income volume in units is 2,000. After taxes, so we're assuming that your fixed cost is $15,000, your after-tax income desire is $6,000. After my taxes, I want $6,000. So you take that number and you have a 40% tax rate. So 1 minus 0.4, which is 40%, gives you 0.6. So you take your $15,000 plus your after-tax dollar amount, which would be $6,000 divided by 0.6, which is 6%, gives you $10,000. So you take those two numbers, add them together, divided by 15, gives you a target income volume after taxes of 1,667 units. All right, your margin of safety. This is simply the cushion for you. This is what do I need to make over my break even. So your margin of safety is your expected number of sales minus your break even number of sales. So this is what I need in order to break even. I need at least this many units in order to break even. And then, but you also know that in addition to those units, you're expecting to sell a certain amount. So you take that number, your expected sales, minus your break even in sales, and it gives you your margin of safety. And then you can use there's also a margin of safety ratio, which is expected sales minus your break even in sales divided by your expected sales, and it just gives you a ratio. Now you see the example on page 64. MOS, of course, stands for margin of safety. So your margin of safety here with $35,000, I'm sorry, minus $25,000 divided by your $35,000 gives you a margin of safety of 28.57%.